Social Security and your taxes. Social Security is perhaps the most common form of income that people receive in retirement. But you may be taxed on those benefits. Sometimes 50% of your Social Security income may be taxed. Sometimes 85% of your Social Security income is taxed. Sometimes none of your Social Security income is taxed. Knowing if you qualify to receive Social Security, when to take it, how much will be taxed, and whether that is enough money to live off is not always easy to understand. Typically, you can claim Social Security anywhere from age 62 through 70. The longer you delay, the greater your future benefit will be. A general rule of thumb is that for each year you delay, you can increase your benefit around 8%. So how do you make that choice? How do you know when the optimal time is? Well, you do that by having a cash flow plan that looks at all your income and all your expenses. Having a cash flow plan helps you more easily determine when the right time is to turn Social Security on, and importantly, understand what the tax ramifications of that decision is going to be. Because here's how Social Security is taxed. When you file your tax return as a single filer and your income is $25,000 to $34,000, you'll pay income tax on 50% of your Social Security benefits. When you make over $34,000, you'll pay income tax on 85% of your Social Security benefits. Now, if you're married and you file a joint tax return, those numbers change a bit. For married filing joint people, when your income is $32,000 to $44,000, you'll pay income tax on up to 50% of your Social Security benefits. When you make more than $44,000, you'll pay income tax on 85% of your Social Security benefits. Assume you're single and you receive $24,000 of Social Security and no other taxable income. In that case, none of the Social Security is taxed. However, as soon as you add additional taxable income, such as income from your pension or interest from your savings, dividends from investments, or maybe you process a Roth IRA conversion or surrender an annuity, or maybe your RMDs, your required minimum distributions, begin. All of that is additional income that pushes taxable income higher, which in turn subjects more of your Social Security benefits to more federal tax. Now, most states do not tax Social Security benefits, but some states do. So you want to know how your state taxes your Social Security. Beyond state and federal taxation, there are a number of factors that may be unique to your situation that you'll want to understand, from the windfall elimination provision to Social Security tax withholding to even withdrawing your Social Security claim. Here's a few action steps that you can take. First, visit ssa.gov to see if you qualify and get your Social Security benefit estimate. Determine when you want to retire and how long do you expect to live for. Understand if you may be executing financial strategies while you receive Social Security. For example, Roth conversions or receiving IRA distributions, or maybe you're surrendering annuities. Finally, understand if you have tax-deferred accounts and how required minimum distributions may impact the tax of your Social Security benefit. With Social Security being a primary retirement benefit that most of you will receive, it's important that you get your Social Security claiming strategy right. If you want to know your optimal Social Security strategy, you need to establish a detailed cash flow plan that takes into consideration all the potential income and expenses and the various strategies that you might implement that are to increase your odds of achieving your financial goals. If you'd like to see how Social Security taxation may affect your overall retirement plan, contact Pure for a free financial assessment.